If you look at the history of price movement in property and interest rate movement over the last, say, 3 decades, the correlation isn't really there. It doesn't automatically go that interest rates go up and prices fall, and they might happen, but there are other factors at play if that happens. You know what I mean? There's times when interest rates have gone up and prices have risen and vice versa. So it is a little bit lazy, I think, of a lot of commentators, a lot of headlines and all the rest of it, just to have these automatic, prices are rates are rising, so prices are going to fall. So there's going to be other things in play if prices fall. And a big part of it is confidence, and who puts their property on the market, and who has to put their property on the market, who has to take the sale price and all that sort of stuff. And so that's why it's a segment of the market that gets hurt or hurts more than other segments. So if you look at, say, who's bought in the last 3 years and say they're more vulnerable, and then of those who have bought in the last 3 years, those who have gone to 6 times, in terms of their borrowing, are more vulnerable. So there's 600,000 transactions a year. Is that sort of how much it basically works? So what we're looking at 2 million property owners, and of those 2 million property owners, what percentage would have really, really maxed themselves out?
Yeah.
And so then you can sort of, to some degree, put some idea of a number around how many are going to be really stretched, and then how many of them vote. All of them, I would presume, but anyway.
They're all required to. That's so. Look, I'm an economist. I do have some faith in some of those models. Only because the models are more sophisticated than there's a relationship one-to-one between interest rates and house prices. It's what else has driven access to, what else, putting in income growth, putting in other factors into the model to sort of work out what's going to drive sort of house prices over the longer term. We're about to find out in the next 2 years whether fundamentals or interest rates are the main drivers at the moment of prices. And it turned out interest rates were the main driver of prices, I think, over that period. So I think it's hard to look at what happened during COVID and not think the interest rates had a really big role to play in where we ended up. And so as that recedes, what else is going to add to the demand or people's willingness to pay for housing at the margin to offset that? And I've struggled to see other things that are going to drive it. Income growth is probably not going to be there to the extent that you'd hope. Access to credit is already pretty open. If Labor wins the election, which, by the time you listen to this, we'll know, it's unlikely that credit standards will be loosened. I'd be surprised. The coalition already loosened them a couple of years ago, and that did drive prices high. I think that was the big driver of prices high before COVID, when there was sort of the recovery after the 2019 election. So my understanding of the models is it's like the expectation of long-term interest rates that end up driving the house price impulse.